Hey guys, my name's Alex and welcome to my YouTube channel. If you don't know who I am, this channel is going to be a little introduction into everything personal finance, investing, saving money, and most importantly, making money and growing it over time. Now, the purpose of the video today is I'm going to be talking a little bit about investing and the best way to grow your money over time. There's so much you can learn online about investing, but a lot of it comes from these personal finance experts who are just trying to sell you a course, or more than likely, they're just trying to make money off of you. So I'm going to give you today 6 tips and tricks that will help you invest for the long term and weather any market, whether it's at an all-time high or an all-time low. So let's dig in. All right, starting us off with number 1, the first tip is going to be diversifying your investment portfolio. I know, everyone talks about diversification, but what does it really mean? Really, it just means don't hold all your eggs in one basket. So I'm talking here about no single stocks. That is so important. Now, I just want you to know, there has never been a single company in the history of the world that has lasted from beginning until end. Back in the 1930s, everyone thought General Electric was this hot stock. Well, you know where GE's at today? It's sitting in my garbage can on the floor. So that is the first thing, no single stocks. Additionally, you can invest in index funds through Vanguard and Fidelity. Now, what is an index fund? Essentially, an index fund is just an investment security that holds all the biggest US and worldwide companies in one single security. My favorite is with Vanguard, VFAX? I don't know how to say it, but it allows you to own the 500 biggest companies in the United States for a whopping grand total of $276. I know, you can calm yourself. So that's my favorite stock index fund. But there's also index funds for bonds. Now, Vanguard has a bond index fund comprised of long-term, short-term government treasuries, corporate debt, and it is Vibitalix. I think that's how you pronounce it. Vibitalix? But Vibitalix is going to cost you about $11 to own every single bond in the world, essentially. Now, by doing this and owning index funds like VFAX and Vibitalix for $276 and $11, you will eliminate any company-specific risk. Meaning, if Amazon has a bad year and their stock crashes by 50%, your investment portfolio will not be hurt that much because you will still have thousands of other companies to bring up your returns. Moving on to our second tip, buy and hold. I know, it's complicated. You just buy and hold. So I'm talking to you behind the camera who's out here day trading penny stocks and Bitcoin. I'm talking to you because you know what? Those are both just scams. My personal philosophy is I don't want to own a single investment, whether it's a stock, bond, real estate, anything that will double in price within 1 to 2 years. I would ideally like to see my investments double in 5 to 7 years. That's because that's more consistent, that's more predictable, that's less volatile. Anytime you're buying an asset with an expectation of it doubling in less than a year, there's an expectation that that asset might also decrease in price by 50% within that year. And so that's what you see with people that are out here day trading pennies, or they're buying Bitcoin and BitConnect. Yeah, that, my friend, is a scam. Additionally, when you buy and hold, it creates taxation advantages. So imagine you're sitting here and you're on your computer Googling and you find Apple stock is trading at roughly $200 a share. And you think, wow, that's a great company, a great investment, so I'm going to buy it. And Apple shares double over the next year from $200 to $400. And you're thinking to yourself, wow, I am just so smart. I am the world's best investor. I'm just going to cash out that double return, that 100% return, because I am a genius. Well, if you held that Apple share for less than a year, you're going to get hit with short-term capital gains. Meaning, if you're in a high income tax state like Iowa, like me, the third highest income tax state, I know I'm not salty or anything, you're going to get hit with ridiculous short-term capital gain rate, where if you would have just held the investment for over a year, you get long-term capital gain rates, which are a maximum of 20% and so much more favorable. So say it with me. We're just going to buy and hold. All right, say it with me. Buy and hold. I know it's complicated. Just buy and hold. Buy and hold. Buy something when you're 20, hold it till you're 60, and never look back. The third tip is don't try to time the market. Now, like we already established, you behind the camera, you're so smart, you're just going to buy low and sell high. But in reality, no one knows whether the market is too high or too low, whether the Fed is going to cut or raise interest rates. Rather, you're better off just dollar cost averaging your investments over a 20, 30, 40 year period of time. So what is dollar cost averaging? It's where you just take a percentage of your paycheck and you invest it every time you get paid, regardless of how the market's doing. So as an example, say you make $1,000 every 2 weeks and you decide you want to invest 20% of that. If you were dollar cost averaging, you would just invest $200 every time you got paid, whether the market was at an all-time high or an all-time low. Investors should be more focused on just trying to be in the market as long as they possibly can. A study showed that from 1998 to 2017, if you just missed the 5 biggest days of trading, your return went from 7% down to 5%. That's just by missing the 5 biggest days. If you miss the 10 biggest days, your returns go down almost 4%. So the research shows we should not be trying to time the market. We should try to be in the market at all time, regardless of how it's performing. Our next tip is to take advantage of tax-preferred accounts. Now, what is a tax-preferred account? A tax-preferred account is just something that allows you to avoid taxation, whether it's today or at some time in the future. So some of you might have a 401k option at work, and they might have a traditional option or a Roth option. With Roth options, you pay the taxes today, and that money that you invest and grow never gets taxed again in the future. While with a traditional investment, you don't get taxed today, and you let that money grow and you defer that taxation until you withdraw that money and it gets taxed in the future. Now, using these tax-preferred accounts is huge because it allows your money to compound over multiple decades without Uncle Sam. Number 5 is to think long term. Now, personally, when I'm thinking long term about my investments, I think to myself, I would not own or invest in a single stock or real estate property that I wouldn't be comfortable owning for 20 plus years. All this goes back to our buy and hold philosophy. I'm not out here thinking about my investments in a 1, 3, or even 5 year time frame. I'm thinking to myself, at 21 years old, what is this investment going to be worth when I'm 61, getting ready to retire, and sipping on mojitos at the beach? I think that my future self is going to thank my 21-year-old self a lot for my investments, and that's how you need to approach your decisions right now with your money. Too many people are out here just thinking, oh, I don't want to worry about retirement. That's so far away. That's 40 years down the road. I'm just going to go out to the bars and party and live in this $1,500 apartment and buy a new Beamer, because you know what? You only live once, man. Yeah, that philosophy is going to get you absolutely nowhere in life when you're 61 and broke. You got to think about your future self, and would you be happier at 61 on the beach, hanging out in your beach house with all your friends around you, or would you rather be broke because you lived the big life when you were in your 20s? I know what I'd rather do, and I guess it's up to you. Finally, our last tip is to not ever get emotional about your investments. This means you don't panic if you buy Amazon and it drops 50%. This means you just sit, hold it. We already talked about this. Don't buy anything you're not comfortable owning for 20 plus years. this all goes back to, I think of Warren Buffett. Do you think he's just over here crying that Kraft went down or that Johnson & Johnson had a scandal? No, he's just hanging out with all his fat stacks of money because he didn't get emotional for the last 50 years. A lot of times, if you're getting emotional with your investment decisions, it means you probably invested money you couldn't afford to lose. So never, ever, ever invest money if you cannot afford to lose it. I remember there was one time, my freshman year of college, I broke my own advice and I thought, I'm going to invest in a single stock. And that single stock was none other than Campbell's Soup. I know, amazing. But after I purchased that stock, on that very next night, I remember I could not sleep. I was absolutely restless, wondering, where's the stock going to be at tomorrow? Is it going to drop? Is it going to go up? And so it's kind of funny looking back, but I sold my Campbell shares the very next day. I was only out a fraction in commissions, but it was a steep lesson to learn that I will never ever buy a single stock again, because it allows me to not be able to sleep at night and gets me emotional, and never ever get emotional. This relates back to our process of buy, forget, and repeat. Do this for 10, 20, 30, 40 years, and trust me, you will be thanking yourself for the decisions you make today. Alright, so that wraps up our video. So if you liked it, guys, be sure to drop a like below, hit the subscribe button. It's free. You know me, I would only do it if it's free, so check it out. We're going to plan on posting about 2 to 3 times a week, so keep coming back to the channel, and I'll see you next time.